That's down on the same period last year. And a new report warns of labour shortages, inflation and struggling economic growth, and says global labour markets will have to change. Good afternoon. This is Business Live with me, Ian King. The Bank of England's Monetary Policy Committee voted today to keep interest rates unchanged at 5.25% for the second successive meeting. But the decision was accompanied by a gloomy set of economic forecasts in which the bank predicted the UK economy would flatline for most of the next year and also warned that inflation would not return to its 2% target until the end of 2025. Well, with me now is Elizabeth Martin, Senior Economist at HSBC. Liz, good to see you this afternoon. No surprise with the decision, but what did you make of the bank's forecasts?
Well, gloomy, as you said. I mean, what they've done is they've essentially said we've got this worse trade-off. We've got slower growth and yet higher inflation. So the worst of both worlds. And of course, a lot of people would, when you think about slower growth, higher unemployment, which they're also forecasting, you might think, well, then it's time for them to cut interest rates. But at the same time, we have still got a monetary policy committee that is worried about inflation pressures in the system. So Andrew Bailey's kind of one of his lines from today was, it is too soon to start thinking about interest rate cuts. So it really feels a little bit worst of both worlds on this set of forecasts.
I mean, the bank, of course, this time last year predicted a recession for this year, which hasn't materialised yet. Is it possible that it's overdoing the doom and gloom?
Yeah, of course it is. I mean, we're not forecasting a recession, but we are forecasting something, fairly stagnant. I think, this is an economy that's been through a lot of challenges. Obviously,
I mean, the really bad news, as far as they're concerned, is that inflation is now not expected to return to the bank's target until the beginning of 2025. And Andrew Bailey doesn't really see the need to reduce interest rates until he sees it going that way.
Sorry, Ian, I just missed your question there. Could you repeat it?
Yeah, sure. You mentioned there, you touched on the personal financial circumstances for a lot of homeowners. Of course, the bad news for them today is that Andrew Bailey doesn't now expect inflation to return to the 2% target until early 2025. And accordingly, he's unlikely to reduce interest rates until then.
Exactly. And it's funny you should say that, because one of my friends who's on a floating rate mortgage was just texting me to ask exactly that question. When are interest rates going to come down? And I have to say, our forecast is not until January 2025. And that's because, the UK does have still 8% wage growth, core inflation above 6%. When we start to see these things coming down, then we can start talking about rate cuts. But as Andrew Bailey said today, we're not in that world yet. It is still a world where it's one thing to say we're not going to raise rates anymore from here. And they're not even saying that, actually. They're saying there's still a possibility we'll have to raise again. But it's quite another to start thinking about cutting rates.
And of course, why do you think it is that the bank doesn't expect inflation to return to target now as quickly as once it did?
So it does primarily come down to this issue of wage growth, I think, and the tightness of the labour market. So one of the adjustments they've made in the forecast today is to raise the equilibrium, their estimate of the equilibrium unemployment rate, which is to say that for any given unemployment rate, wage growth is going to be a bit higher and inflation is going to be a bit higher. So they're saying that the labour market is structurally kind of tighter, and that means more inflationary. And we do seem to have a uniquely inflationary labour market here in the UK. If we compare wage growth here to wage growth in Europe or in the United States, it is considerably higher. And that's why we think the Bank of England is going to be the last of the central banks to cut. We think the US will be cutting by Q3 of next year, 2024, European Central Bank by the end of 2024, and then the Bank of England last of all, because we do have this pay growth driven inflation, and it will take time for that to wash out.
OK, Liz, we've got to leave it there, I'm afraid. Good to see you again this afternoon. Thank you.
Thank you.
Well, we're going to stay with the labour market now because one big feature of advanced economies like the US, the UK and the EU since the end of lockdowns has been the strength of the jobs market and the relatively low levels of unemployment. But research published today by the asset management giant PGIM suggests that big changes are coming to labour markets due to the ageing workforce, skill shortages, AI-driven automation and the weakening of globalisation. Well, joining me now for more on this live from New York is Tomer Hyatt. He's Chief Operating Officer at PGIM. Tomer, good to see you again. I mean, you think this ageing of the workforce is going to hit entrepreneurship and innovation, which is quite startling.
It's one of the sort of less discoverable, less discussed pieces, Ian, where when you have, these baby boomers still dominating the workforce, you just see less job changes. You see people moving less. You see older companies, not just older employees. And that means less entrepreneurship. The data supports that despite Silicon Valley, despite some of the other venture capital hubs, less new business formation, less innovation. So it's actually a dual aging of companies alongside people in the US and Europe.
Now, we often think of Europe and the United States as being the countries most likely to be hit, the territories most likely to be hit by the ageing workforce. You think there are a lot of other places as well, though, not least China?
Well, the 4-2-1 policy and structure in China with the one-child policy and meant that what was a demographic plateau or a slow climb over many decades in the US and Europe is a cliff for China. And they have not developed the social mechanisms and the economic mechanisms to cope with it. And then they've got an overeducation problem. The job shortages in China are emerging in agriculture. They've got a very highly skilled workforce that wants to work in technology. So the education mismatches and a demographic gap that is going to be very hard to fill, particularly when you think about their migration policy, which, unlike the US or Canada, really makes it hard for them to fill the gap.
That's a really interesting point that you've made there, because you talk in this paper about skill shortages, but they're not necessarily in the parts of the economy that people might expect.
No, they are not. And in fact, it's not. For example, everybody knows that renewables or chip manufacturing, particularly with all the industrial policy that's bringing it back to the US or the EU, is a huge gap. But it's not, Ian, when we looked at the data, not the kind of the, big innovators or the people who designed the new chip, which are in shortage. It's the technicians, it's the vocational skills who will go and put the solar panels, who'll manufacture the hydrogen cells, who'll actually do the technical manufacturing job once you've designed a chip. That's where we're going to see really big shortages in the European Union, in the UK and the US.
And this, of course, is going to have all kinds of implications for migratory patterns.
It's certainly going to mean that skilled legal migration to fill the gap is going to be key. It's also going to impact where you do the work. Can some of the countries with larger working age populations, where you have the technical skills, I'm thinking of an India or an Indonesia, can they fill their gaps where they have the population, but they don't have the industrial policies, the government stabilities, the legal regimes, which attracts capital from the West to those countries? You've got the labor, you need to build the rest of the infrastructure. And that's really creating a polarization, which is not just demographic destiny, but is in the control of these governments. Can they create the right policies to become centers in this new world with this very new labor map?
All right, Tomer, I'm afraid we're out of time, but it's good to see you again this afternoon. Thank you.
Great to talk.
Now, the world leaders attending the government's AI summit are not the only international dignitaries currently in the UK. A Peruvian government delegation led by the country's Prime Minister is here trying to grow trade and financial deals between the two countries. It's a little-known fact that the UK is currently the biggest foreign direct investor in Peru, with a stock of more than $6 billion US. But Peru is hungry for more. Well, joining me now is the Peruvian Minister of Foreign Trade, Juan Carlos Matthews. Minister, welcome to you. Peru is currently the third largest exporter of fruit to the UK. What are the other big exports?
Yes, we are really increasing our exports to UK. We are the third exporters of gas to USA. The first one is USA, the second Qatar, and the third one is Peru. But as you mentioned, in the area of fruits and vegetables, we are growing very, very fast. We are right now the largest exporter of grapes in the world, the largest exporters the second largest exporter of avocado, blueberries, asparagus, and UK is becoming a very important market for us.
Which are the biggest opportunities to grow trade, do you think?
Yes, I think we have a lot of opportunities in both senses because we are importing some final products from UK, but also we are interested in technology. We are interested in investing in infrastructure, and we have been discussing these points, not only investing in mining, but also in infrastructure, as I mentioned. And in terms of export, not foods, but not only refer to fruits and vegetables, but seafood, fishery for human consumption, and textiles. We are a strong exporter of textiles from cotton and fine hairs. And one more time, UK is a very interesting and potential market for us. No?
You mentioned mining just now, and obviously the likes of Rio Tinto and Anglo American are very active in Peru. But what about materials for electric vehicle batteries? This is an area where I think you're really pushing to become a major player.
Yes, you are absolutely right. And in the case of this company that you have mentioned, Anglo American, I think they are an example of good practices because they are dealing with all the stakeholders that should be involved in the process, talking with the community, with the government, and they as the investors. So we are looking to the mining sector and all the industries around it that are also growing and with the participation of UK companies here in Peru, no?
Now, more broadly, over the last few decades, Peru's economy has grown at roughly twice the pace of other economies in Latin America and the Caribbean. But you entered a recession this year. What's gone wrong? Yes,
it is a difficult year. We have at the very beginning of the year some protests that were very affected very much our economy. And we had also some problems related with diseases. And in addition to that, we have the problem of El Niño that is going to have an impact at the end of the year. We hope that at the end of the year, we are not going to be in recession. We have been in recession until the last month, but we hope we are going to be not in recession at the end of the year. And we are expecting to have a growth on 2024 of about 3%. That would be a very good level of growth in comparison with the rest of Latin America, no?
It would also be pretty good compared with the United Kingdom too, Minister. Good to talk to you this afternoon. Thank you.
Yes, thanks to you.
Still to come here on Business Live, we'll have a look at how the markets are doing this Thursday afternoon. Don't go away.
I'm Lisa Dowd and I'm Sky's Midlands correspondent. We can reveal that the driver who hit Harry Dunn is 42-year-old Anne Sakulas.
Just met the president and we never thought we'd get this far.
This is what they're up against, is back-breaking work. Water levels are dropping, but no one knows what impact further rain will have. What would you do if this place wasn't open? We take you to the heart of the stories that shape our world.
It's really scary.
In this community, I'm told that everybody knows someone affected by COVID. Change seems tantalisingly close in this corner of the UK. This is my patch, my specialism. It's also my home.
Fly Emirates, fly better. Fly Emirates, fly better.
Thank you.
Welcome back. Before we get on to the market report, here are some other business stories that have been making the news today. Shell has become the latest oil major to report a year-on-year drop in profits on the back of lower oil and gas prices. The company reported earnings of $6.2 billion for the 3 months to the end of September. That was up 23% on the 3 months to the end of June, but compared with the same period last year, it was actually some 34% lower. Well, apart from lower oil and gas prices, that result also reflected lower production at Shell's liquefied natural gas operations. However, the company reported a better outcome from its gas trading operations in contrast with BP earlier this week. Shell also announced that carrying out a $3.5 billion share buyback for the next 3 months. That's up from one of $2.7 billion during the previous quarter. The shares have finished by more than 4% higher this afternoon. Shares of BT have risen by more than 5% today after its quarterly results came in ahead of Citi forecasts. The owner of EE reported underlying earnings of £2.06 billion for the 3 months to the end of September. That was up 3% on the same period last year. For the half year, BT reported underlying earnings of £5.3 billion, which was up 2% on a year ago. The results are the last to be presented by Philip Jansen, who steps down as chief executive early in the new year. He said today that BT had a bright future. Sainsbury's said today it was attracting shoppers from all of its competitors, including the hard discounters Aldi and Lidl, as it held a rise in grocery volumes on the back of lower food price inflation. The UK's second largest supermarket chain, which also owns Argos and Habitat, said it had spent £118 million since March on lowering prices and said it had enjoyed record market share gains as a result. Pre-tax profits for the 28 weeks to the 16th of September came in at £275 million. That was down 27% on the same period a year ago, when results were flattered by one-off legal settlements. Shares of Sainsbury's are up by some 4.5%. Well, the pound briefly rose against the US dollar after the Bank of England stressed that there would be no cuts in interest rates anytime soon, but it's gradually given back those gains as the afternoon has worn on. Sterling currently ahead by 1/4% against the greenback. It's off by just over under 1/6 of 1% against the euro. The single currency, meanwhile, up by nearly 0.5% against the greenback. On the equity markets, well, stocks in Europe have enjoyed another positive session. There you go. All of the main continental European indices around 1.5% to 2% higher on the session. Talking points include the Danish drugs giant Novo Nordisk, which is, of course, Europe's largest company. That's ahead 1.75% in Copenhagen after it posted record sales and profits during the latest quarter. Well, another talking point this afternoon is Ferrari. The share's up some 5% in Milan as it reported record order books. Well, here in London, the FTSE 100 has also finished in positive territory, up nearly 1.5% in a broad-based rally. Property groups, Land Securities and Segro have been leading gainers this afternoon. That's on hopes that interest rates may have peaked. Look at that, Landsec's up 5.5%. We've also had a clutch of stocks, including BT, Sainsbury's and Smith & Nephew, all of them positive territory on the back of results statements. Smith & Nephew, they're up by more than 4%. Also reporting today, the gaming group Entain. I think they finished about a percentage point or so higher as well, 1.25%, I think. Not too many FTSE fallers to mention, but the consumer healthcare group Haleon has fallen by 2.25%. 0.25% after its quarterly sales came in shy of expectations. Outside the FTSE, the specialist lender OSB Group, that used to be called One Savings Bank. Indeed, that's what we're calling them on the screen there. Look at that, up 16%. That's on the back of a trading update, while the telecommunications infrastructure provider Helios Towers, that's finished up some 11% for similar reasons. The oil price yesterday hit its lowest level since Hamas terrorists attacked Israel on the 7th of October. It's rallied today slightly. A barrel of Brent crude is currently changing hands at $86.19 a barrel. That's up just shy of 2%. Well, joining me this afternoon is Freddie Cahoon, Investment Director at JM Fin. Freddie, good to see you. Let's start with the market reaction to the Bank of England. I mean, a bit of a muted response in gilt and currency markets, but on the equity markets, a bit more positivity.
Yeah, indeed. So, as you said, the FTSE 100's up quite strongly, but the real focus today has been the FTSE 250, the UK, sort of more domestic-focused index, has had a real rally today, up over sort of 3%. Now, this is on the back of a very disappointing October for the index as well. But within the FTSE 250, there's lots of UK-focused consumer-related stocks and also a lot of property stocks that you've already highlighted.
Yeah, and the house builders too. All of them have had a good session today.
Yeah, indeed. House builders and real estate investment trusts as well. One set of results not mentioned is Derwent London. So they were particularly strong today, saying that lettings have come in ahead of market estimates and also they see continued strong demand.
Yeah, I mean, very, very well-run company, Derwent London. We've had the CEO of them on the programme in the past. What about some of these results? I mean, I've highlighted the fact that a lot of companies have been beating expectations today, but one that caught your eye was Howden, not quite so good.
Yeah, one of the only share prices down in London today. Now, Howden sell mid-market kitchens, predominantly in the UK, so it provides us with quite a good lens into consumer behaviour, particularly large ticket items as well. They were fairly resilient, actually, but they did highlight weakness in their core UK market, saying customers are taking longer to decide on their transactions. So that's what they've led to lowering their overall estimates for the full year to the lower end of their guided range. So, you know, it's operating in a difficult environment, but they are still initiating good ideas, such as next day delivery and expanding their range. So they are taking share.
They are, yeah, and they're opening sites as well, which is no mean feat in this backdrop.
Yes, indeed. They're called their depots, and they so it's a sort of franchise business, and each depot has autonomy over what they can do, or some autonomy, and that provides really good customer service at the end of the day because the staff at those depots are incentivised. So, as I said, well-run business, slightly difficult backdrop, but they're doing everything they can to offset that.
What did you make of the numbers from BT? I mean, you don't see BT shares moving like this on results day very often.
No, not really. And indeed, the experience of the last 2 years for shareholders has been tricky at BT. I mean, we saw them as a little bit mixed, actually. Revenues came in line. Their Openreach and business divisions came in line. Consumer was a little bit weak. They held the dividend, so that's good too. But the focus really is on Openreach and the fact that they're losing broadband customers to quite a significant degree. Now, the company guided that they would lose 400,000 across the full year, but at the half year, they'd already lost 255,000 customers. So they're going to need to do something to reverse that trend in the second half to make sure they hit their guidance.
All right, Freddie, always good to see you. Thanks for joining me today. That's it from me. I'm back again with Business Live tomorrow morning at 11:30. Hope very much to see you then. In the meantime, do stay tuned because coming up after this short break, it's the News Hour with Barbara Serra. See you tomorrow. Cheerio.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.